Right now, much of the market conversation around Anjing Food is focused on short-term cyclical headwinds. Our view, however, is that this misses the larger story. The more critical question isn't if the company faces challenges, but how these very challenges are forging its long-term strategic position. Our focus today is to separate that market noise from the fundamental reality. So here is our core thesis. We believe current market sentiment is overlooking a crucial dynamic. The very factors that appear to be headwinds, controversies around pre-prepared foods, shareholder actions, and confusing cash flow numbers are, in our view, actually reinforcing Anjing's long-term advantages. These issues are either misunderstood or being strategically managed, all while the broader industry structure points towards significant, inevitable consolidation. Here's how we'll structure this analysis. First, we're going to deconstruct the three primary market controversies surrounding the company. Then, we'll zoom out to examine the industry's consolidation potential from a global perspective. After that, we'll define Anjing's core competitive advantages, its moat. And finally, we will provide a clear-eyed view of the key risks that need to be monitored. Let's begin by tackling those key issues that have been a source of market anxiety. The goal here is to distinguish the noise from the underlying operational reality of the business. The first controversy is the Shibe incident, the public backlash against restaurants using pre-prepared dishes. The central question this raised for the market was immediate. Does this signal a fundamental threat to Anjing's entire business model? The market fear here, we believe, misinterprets the root cause of the anger. The public outcry wasn't really about the food being pre-prepared. It was about the lack of transparency from the restaurants. This actually creates a strategic opportunity. It erodes trust in opaque business-to-business supply chains and strengthens consumer preference for trusted, clearly labeled brands, which is precisely Anjing's strength in its consumer-facing business. The second point of concern that's been raised is shareholder stability. This really centers on the company's governance and a history of share sales by key executives. So, is it a red flag? Now, while the historical concerns over share sales are valid points of data, the recent context is critical. The controlling shareholder has made an unprecedented 5-year pledge not to sell shares. The timing here is key. This pledge was announced just days after the board approved plans for an H-share listing. This suggests a clear strategic move to signal stability and build confidence with international investors ahead of a major global move. And the third controversy is a financial one, and it's one that has caused a fair bit of confusion. It's the apparent paradox of strong reported profits alongside negative operating cash flow. How is that possible? Well, let's look at the numbers. For the first half of 2025, Anjing posted a net profit of 676 million RMB, but its operating cash flow for the same period was a negative 163 million RMB. That's a gap of over 800 million, and a disconnect that large rightly raises questions about the quality of the company's earnings. The explanation, however, lies in the company's distinct seasonal operating model. Anjing's peak sales season is concentrated in the colder fourth and first quarters. To meet that massive demand, it has to aggressively build inventory during the second and third quarters. That stockpiling requires a huge outflow of cash for raw materials and production. So this discrepancy isn't an indicator of financial distress, it's a planned, predictable feature of its annual business cycle. All right, having addressed those immediate controversies, let's now shift our perspective. To truly understand Anjing's position, we need to look at the broader industry landscape and its long-term trajectory. This chart provides a really stark comparison. In China, the top 5 players in the frozen foods market control only about 15 to 18% of the market share. Now compare that to a mature market like Japan, where that same figure is around 64%. This massive gap highlights just how extremely fragmented China's market is today, and it signals immense potential for future consolidation. And it's not just about consolidation. The potential for overall market growth is substantial. China's per capita consumption of frozen foods is only 10 kilograms. That's dramatically lower than the 62 kilograms in the US or 25 in Japan. This signals a powerful dual opportunity, capturing a greater share of the market while the entire market itself continues to expand. The path to consolidation tends to follow a clear historical pattern that we've seen in markets like Japan and the US. The key drivers are things like the build-out of cold chain logistics, standardized demand from large restaurant chains, the growth of supermarket channels, and economic cycles that squeeze out smaller, less efficient operators. Many of these forces are at play and accelerating in China right now. This brings us to the next logical question. If consolidation is the endgame, what are Anjing's specific advantages that position it to lead that charge? What is its core moat? At the very heart of Anjing's strategy is what it calls the Shao Di Chan model. This essentially means local production for local sales. Instead of shipping from one central location, Anjing has built a nationwide network of factories close to its major consumer hubs. This dramatically reduces transportation costs per ton, creating a powerful and structural cost advantage that is very, very difficult for competitors to replicate. This model also positions Anjing very differently from its peers. Competitors like Sanquan and Sinion are primarily consumer-facing manufacturers focused on staple foods. Guaquan Shehui, on the other hand, is a retailer, not a manufacturer. Anjing stands apart with a fully integrated model, covering multiple product categories and servicing both business and consumer channels with its own manufacturing base. So, ultimately, Anjing's primary competitive advantage isn't dominance in a single product like fish balls. It's the comprehensive and synergistic ecosystem it has built across all its products and channels. This integrated network creates a resilience and efficiency that its more specialized competitors struggle to match. Now, any complete analysis requires a sober assessment of the primary risks. So let's turn our attention to the key challenges that Anjing faces moving forward. We see three critical headwinds to monitor. First, that high-leverage seasonal model creates significant working capital pressure. If peak season demand comes in weaker than anticipated, the company could face serious inventory and cash flow issues. Second, there's M&A integration risk, particularly as it moves into new categories like frozen bakery. Success there is not guaranteed. And finally, international expansion, while a huge long-term opportunity, is fraught with uncertainty. So in conclusion, Anjing clearly faces significant short-term challenges. The central question for the market, therefore, is not whether it faces these headwinds, but whether its scale, its operational model, and its strategic positioning are robust enough for it to emerge from this cycle as the industry's undisputed leader. That long-term outcome is what the market will ultimately be judging.